Welcome back to Investing Talk Podcast.
Today we are counting down the top 5 stocks to buy right now based on our latest research. Our focus today is maybe a bit different, really looking at these asymmetric growth plays. So companies going through pretty big capital structure changes or, event-driven catalysts.
This is a big one. Before we get to our first pick, be sure to subscribe, like, and comment to support the show. And hey, if there's a specific company you want us to look into, definitely leave it in the comments below.
All right, let's start the countdown. What's the first company on our list?
First up is LM Funding America. The reason it's standing out is its unique asset-backed strength, and I think crucially, its pretty aggressive capital return strategy. It's a small-cap company, and they're running this fascinating dual model. You've got traditional specialty finance, but combined with high-growth Bitcoin mining operations.
Right, and it's the balance sheet that makes this kind of an unusual investment thesis, wouldn't you say? You have this speculative asset, Bitcoin, that's basically providing a calculated floor for the entire share price.
That's exactly the key insight. The company disclosed, I think it was late October, that the value of their Bitcoin holdings, it was around $31.9 million. Now, when you actually do the per-share math on that asset value alone, it works out to roughly $2.70 per share.
And that $2.70 figure, that's the really crucial anchor here because, like you said, it was significantly higher than the stock's market price when they calculated it. So the market was, essentially giving you the operating business for free, maybe even pricing it negatively because people see crypto mining as, volatile.
Right, but the operations themselves, they're actually showing real momentum. Bitcoin production surged 27% month over month back in October, and that was driven by their new Mississippi facility finally coming online. So this isn't just paper value. The mining is actually scaling up pretty fast.
And this rapid cash generation, it gave management the confidence to do something pretty bold for shareholders. They authorized a $1.5 million share repurchase program. And get this, they've already bought back nearly a quarter, 24% of the existing float. Yeah, that's a massive commitment to shareholder value, and it's funded, kind of ironically, by those speculative crypto holdings. We expect the full Q3 earnings release, probably around November 15th, to confirm this operational trajectory.
It's quite a strategy, isn't it?
Yeah.
Using the capital appreciation from crypto to directly fund traditional shareholder returns. Okay, moving on then. What's your next high conviction pick?
My selection is Dragonfly Energy. This is another company focused on a, huge structural market, but it really needed an immediate operational reset just to survive. These guys are leaders in deep cycle lithium-ion batteries. You see them in high growth sectors like RVs, marine vessels, and those big off-grid installations.
Now, this company has definitely faced some, serious financial headwinds. I remember seeing widening net losses throughout the year. So for the listener, how did they manage to pull themselves back from the brink to, warrant a spot on this list?
Well, it really came down to a decisive liquidity move. Despite those past losses, they just executed a definitive term loan restructuring. They announced that just earlier in November. That significantly eased their near-term debt crunch. But the critical action, I think, was the proactive fundraising. They successfully raised $25 million. That was via a 20 million share offering at $1.25 per share.
Okay, so they accepted quite a bit of dilution there, which, often hits a stock short term. But they basically traded that pain for financial survival and working capital. Is the market buying that trade-off?
It seems like they are, yeah, because that cash injection gives them the fuel they need to actually capitalize on those long-term structural tailwinds in the battery market. I mean, people are increasingly demanding better, lighter, safer lithium batteries for everything from, mobile homes to boats. And furthermore, we did notice that the sole analyst covering the stock rates it as a strong buy. Their 12-month price target is $1.50. That implies, about a 38% potential upside from current levels, assuming, of course, they execute flawlessly.
Right, but that target really hinges on confirmation. Their Q3 earnings, expected mid-November, like you said, those will be crucial. They absolutely have to demonstrate that the operational improvements are real, not just a result of getting more cash.
Precisely. They bought themselves time and capital. Now they really have to perform.
Okay, shifting gears now from energy storage to, arguably the ultimate high-risk sector, the commercial space race. My next choice is Intuitive Machines. This one's definitely for investors looking for exposure to lunar infrastructure, which is, rapidly moving from just a government concept to a commercial reality.
Yeah, what's fascinating about these space companies is that their success isn't really defined by consumer purchases, right? It's all about those high-value, defensible government contracts. So how does Intuitive Machines' revenue picture look?
Well, the contract momentum is pretty exceptional, actually. Their trailing 12-month, or TTM, revenue is already strong. It's nearly $226 million. And that's up significantly year over year. So this growth isn't just speculative, it's driven by solid contract wins. One recent example is an $8.2 million Air Force extension for nuclear power technology development. Plus, they've got multiple significant NASA payload contracts for lunar missions.
Right, and the key here isn't just, landing on the moon. It's about building a moat. They're focusing on unique, high barrier to entry tech. Lunar landers are one thing, sure, but that $8.2 million extension for compact Stirling nuclear power systems, that's where the real long-term value could lie.
Absolutely. They are diversifying beyond just the lunar landings. They're creating unique advancements like those compact power systems you mentioned, and also orbital transfer vehicles. Those are essential for any kind of sustained human presence in space, right? And this approach helps prevent competitors from easily replicating what they offer. Uh, Technically speaking, the stock is confirming sustained bullish momentum, too. It's trading cleanly above both its 50-day and 200-day moving averages.
Yeah, that technical signal, especially combined with the contract security, that's why analysts are seeing significant upside, potentially ranging from, 16% up to maybe 50% from current prices. It really signals institutional confidence in that long-term, high-margin government work.
A strong case, definitely, for growth driven by state infrastructure needs. Okay, what's number 4 on your list?
The fourth company we're looking at is Unity Software. This one represents, a textbook turnaround story, I'd say. It was confirmed by a truly staggering earnings beat that seemed to surprise almost the entire market. For years, Unity really struggled to convert its, industry standard 3D engine into sustainable profitability.
Oh yeah, they've certainly been through periods of major investor skepticism, plus some operational missteps. Remember those controversial pricing changes? So what did the Q3 results show that definitively signaled a reversal? What changed the narrative?
Well, the Q3 results just materially beat expectations. And I mean, they fundamentally changed the story. Revenue hit $470.6 million. But the really critical figure was the positive non-GAAP EPS of $0.20.
Okay, can you just clarify that for listeners who might be less familiar with those terms? Why is non-GAAP EPS so important here?
Sure. So non-GAAP EPS, it basically refers to their adjusted earnings. It strips out things like one-time costs, restructuring charges, amortization, that kind of stuff. The fact that they posted 20 cents in positive adjusted earnings means their core run rate operations are actually profitable now, which is just a massive swing from the loss the market had expected. Analysts were modeling, I think, a loss of 24 cents per share.
Wow, that swing from a forecast loss all the way to positive profitability, that really feels like the defining moment for sustainability.
It is, and it confirmed their operational discipline. They also achieved positive operating cash flow in Q3. They now boast a war chest of $1.6 billion in cash, and management provided raised guidance for Q4. The growth driver, though, is probably their strategic shift away from just gaming. Their expansion into AI, particularly the Unity Vector AI, and diversification into industrial design, automotive, complex simulation markets. That really fortifies their leadership beyond just video games. They're sort of becoming the underlying platform for the real-time 3D metaverse, but for corporate applications.
Right, that focus on industrial AI applications, that's where the huge scalable revenue could come from. Definitely secures their spot on this list. Okay, finally, completing our top 5, we have AST Strive. Now this one feels like the most speculative, maybe the highest risk, highest reward play of the entire group. Seems entirely focused on imminent capital market activity.
Oh, it definitely comes with the largest warning sign of the group, yeah. Investors need a very high risk tolerance here, but the short-term catalysts are, undeniably strong.
Okay, so tell us about the contradiction here. We know the company has had persistent operational issues. They reported a negative net income of about, $2.66 million. So where's the underlying strength?
Well, the strength is really in its liquidity, which is almost bizarrely high given its profitability struggles. They bust a quick ratio of 4.4 and $2.16 million in working capital. Now, the quick ratio, that measures a company's ability to meet its short-term debts with its most liquid assets. A 4.4 suggests extreme, almost unusual safety. They are asset-rich and cash-rich. which fundamentally contrasts with their negative net income. And that juxtaposition, that's really the investment thesis here. They seem safe from immediate collapse, which gives them options for expansion.
Okay, so they have a solid foundation of existing capital. What's the immediate upside driver then, the thing set for November?
The most immediate catalyst is the planned initial public offering of its subsidiary, SATA stock. That IPO is scheduled to settle around November 10th, and it's specifically designed to inject fresh capital for immediate acquisitions and expansion into lucrative, high-growth, Bitcoin-related assets.
Okay, but given their past operational struggles, that new capital really needs to be deployed with like razor-sharp precision to justify the current valuation. The execution risk here seems paramount.
Absolutely, and the market is pricing in that success, which is why the stock has seen just massive volatility,
Yeah.
including, I think, a 20% surge in price over just a single week on this positive news. So for the listener, this is definitely an aggressive growth bet. It's based on future capital deployment, and caution is certainly warranted due to the, well, high degree of uncertainty regarding how well they'll actually execute that expansion.
So to recap, our 5 stocks to watch are LM Funding America, Dragonfly Energy, Intuitive Machines, Unity Software, and AST Strive.
A solid list of event-driven plays there. As always, do your own research before making any investment decisions. Thanks for tuning in.
Yeah, thanks everyone. And before we sign off, let's maybe just look back at the common thread running through this pretty diversified list. It's this surprising convergence, isn't it, of institutional confidence and really high speculative volatility for our sectors like space, crypto mining, and these AI turnaround platforms.
Yeah, if you look at the raw data, some of these names, like Dragonfly Energy, it showed weekly volatility figures nearing 40%. And AST Strive saw even wider swings than that. Historically, that level of extreme price movement was a clear signal for large, risk-averse institutional money to just stay away.
Right. Yet we noted increasing institutional ownership in Unity software. It's nearing, what, 83% now. And there are clear institutional inflows into LM Funding America, especially following their buyback announcements. So the market seems to be actively rewarding, maybe even expecting, these highly volatile events, the IPOs, the massive debt restructurings, the share repurchases.
So the question you kind of need to consider now is, does this signal a fundamental shift in how large funds are managing high-growth risk? Are institutional investors now treating extreme volatility almost as a necessary feature, not a bug, in this relentless hunt for asymmetric returns? Something to explore on your own.